This is how typical balance sheet would look like. A very old T format, simple structure of balance sheet. Of course, they are not drawn this way today, but this will just give us some flavor. You'll probably have some equity here. Not probably, you'll definitely have some equity here. Can be a negative balance sometimes, but you'll usually have something. So let's just say you have equity of 100 followed by long-term liability of say 50. You will have short-term liability, which includes creditors, which includes bank loan, like short-term bank loan, so as to say, which can also include some other, trade finance. Let's just say collectively these come to around 25, which means you have an overall balance sheet of 175 against all the liabilities, which is external money. So against the liabilities, which is external money, these two are your external finance providers. This is your owned money. But from a stakeholder perspective, we have discussed that equity providers are a stakeholders. Of course, loan providers are another stakeholders. The creditors are again another stakeholder, because besides providing credit as creditors, they also supply goods. They are suppliers to us too. So we have equity, long-term liability, short-term liability. There are multiple stakeholders in between. These are shareholders, others are stakeholders. Even shareholders are a kind of stakeholders, but all of them collectively are providing me finance so that I can do my business. So I get money from a lot of sources, and the money gets utilized into my business. How does it get utilized? Number one, I'll have long-term assets, which includes plant, machinery, land, building, furniture, fixture, a lot of fixed assets, so as to say, which will probably combine to, I don't know, maybe 100. Simultaneously, you're going to have certain short-term assets. These are going to be critical as well. You will have inventory, the stock which you're holding, which you can sell at any point of time. Inventory can also have a little bit of subdivision within that. It's not going to be important to us right now, but that is another structure that we need to be aware of. Besides inventory, we will have debtors. We will have some cash, some amount in the bank. Some amount can be liquid assets. When I say liquid assets, they can be marketable securities, which can be sold at any given point of time. Examples can be, let's just say, fixed deposit with bank. It can be notice deposits. It can also be, so you can have fixed deposits, notice deposits. You can have, some cash deposits here and there, or you can also have some corporate lines which you have provided. So there can be some amount which you have in excess, which you can deposit, and they are liquid, they're marketable. You can get that money back at any given point of time. So all of this combined will, let's just say, provide you with another 75 in this situation. So your total balance sheet will always balance, and you will have 175 over here as well.